So, Peter, I asked you before, but I want to re-up. How fast does this manifest? We're already starting to see price inflation in a wide variety of areas in American life. But when does this actually turn into the sort of stagflation that we saw in the 70s or even something worse than that? When do Americans start to feel this so severely that it becomes a political issue for the people in power?
Well, I think the trigger is going to be the exchange value of the US dollar. See, what's happening now and our get out of jail free card is that even though you have a lot of Americans who aren't working, you have a lot of people in other countries who are working. Let's say China, right? You have all these people who are going to work. They're in factories, they're producing all this stuff, and then they load it up on container ships and they send it to America. So even though Americans aren't producing, we still get to consume because we live off the fruits of the labor of people in China and other parts of the world. Now, the reason that Chinese are willing to give us their products that, they actually had to use real resources to create, they needed capital, they needed labor. The reason they're willing to give us this is because we're giving them dollars. But all the dollar is a piece of paper. Doesn't have any actual real value like all the consumer goods that we're getting from China. They're just getting IOUs. Now, when the Chinese and the rest of the world lose confidence in the future purchasing power of those IOUs, they're not going to want to accept them anymore in exchange for their stuff. And then what's going to happen is you're going to see the dollar really start to fall on foreign exchange markets. And that's when the inflation chickens are really going to come home to roost in a way that it's impossible for the government to ignore the reality or just point to a doctored CPI and try to say, oh, prices aren't going up. And then this is going to become a real problem because I think the next real recession is going to be triggered by inflation. As the costs go up so much, businesses start firing people because they need to stay in business. And consumers, even though they're spending a lot of money, they're spending it on food. They're spending it on energy. So they don't have money left over to buy other stuff. And so they have to stop buying other stuff. And now all the people who earn their living selling that other stuff, well, they lose their jobs. And now we're in a recession that is caused by inflation. And now what does the Federal Reserve do? Because their normal prescription for a recession is to create more inflation, print more money. But if you have an inflation problem, how do you pour gasoline on that problem? By creating even more inflation. You can't. So the Fed is in a box that they can't get out of.
So, Peter, when it comes to inflation, there are a lot of concerns among conservatives, particularly that in 2009, the Barack Obama's stimulus packages, the raising of the spending rates from $3 trillion by the federal government to $4 trillion a year, that was going to lead to some sort of runaway inflation. It didn't really materialize. What is the difference this time as opposed to what happened during the last recession?
Well, first of all, again, we got to remember that inflation, by definition, is the expansion of the money supply, right? That is literally what is being inflated because prices don't expand. Prices go up, prices go down. It's money supply that can expand and contract. And if you go back and get an old Webster's dictionary, even from the 1970s, and you look up inflation, it will define it as an expansion of the money supply. Now, at some point, they added to the definition an expansion of the money supply that results in a rise in prices. But the rise in prices was a result of inflation. It wasn't the inflation itself. So we had a lot of inflation following the 2008 financial crisis. And I think the initial effect of that inflation was that it prevented prices from going down. Prices were set to fall, which would have been a relief to the economy so that during tough times, the cost of living could have gone down. But the inflation that was created prevented those prices from falling. And so you just don't notice it in that respect, but it was still there. But also what happened was the dollar in 2008, when we had the financial crisis, the dollar was at an all-time record low. And if you remember where commodity prices were, oil prices had just moved up to $140 a barrel. All commodities were going way up. And when the financial crisis actually happened, commodity prices collapsed and the dollar rose. And so that was like a buffer, and that helped spare us from a more protracted increase in consumer prices. And we were able to rely more heavily on foreign imports during that period where the dollar was strengthening. But fast forward to where we are today, commodities are just starting a new bull market. The dollar is starting a new bear market. And the size of today's deficits dwarf. I mean, we were running at most $1 trillion deficit at the peak, maybe 1.1, 1.2, when Bush left office and Obama came in. We're now at like 4 trillion. The government is printing almost 70% of the money it spends. I mean, the government is spending $8 trillion almost, and not even collecting $3.5 trillion in taxes. This is unprecedented. When we started the inflation in 2008, the Fed's balance sheet was maybe 800 billion. It's now almost 8 trillion. So we're at a much bigger point. And if you go back to 2008, 2009, we were borrowing a lot of money, but the Chinese were lending us the money. The Japanese were lending us the money. The Saudis, the Russians, the whole world was lending the U.S. government money. They're not doing that anymore. We have to do it all by ourselves. The Fed is not the buyer of last resort. It's the buyer of only resort. So we can't rely on other countries to loan us the money. The Fed has to print the money. Plus, you go back to 2008, Social Security was still a net lender to the U.S. government because the Social Security system was collecting more in payroll taxes than it was paying out in benefits. That's the opposite today. Today, Social Security is not collecting enough taxes to cover the benefits it's paying. So it is also now selling U.S. Treasuries, whereas in 2008, it was buying U.S. Treasuries. So I think it's night and day where we are right now. And I think the Fed, it's a false sense of complacency to think that, oh, we dodged the bullet last time, so we're going to dodge it again. This isn't a bullet this time. This is a hand grenade, and we're stepping right on it.